APAC's asset and wealth management industry recently saw fund managers across the region prepare for a new Trump presidency, Singapore steal a march on Hong Kong to become a digital asset centre, Hong Kong alter its capital investment entrance scheme requirements, and China reportedly again ask investors to reduce stock selling. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC. APAC's fund houses are bracing for the return of President Trump to the White House and anticipating a period of uncertainty as the potential impact of trade and investment policies, especially those targeted against China, are unveiled. Observers and experts note that while the president is likely to pursue a less onerous regulatory policy in the USA, regulations targeting China would be an exception to this, along with a potential 60% tariff on Chinese imports. Further, Trump has pledged to repeal 10 federal regulations for each new regulation imposed, and will introduce policies with the objective of making the USA the crypto capital of the planet. These policies could result in extra regulatory scrutiny, PR risk, and possibly regulatory risk applied to US fund managers with operations or investments in China. A full-blown trade war would further exacerbate the pressure and risk. Geopolitical factors are also likely to play a much larger role in the business and investment decisions of fund management companies across the region, with asset managers looking at new ways to effectively price geopolitical risks and model scenarios. How the coming 4 years play out with respect to APAC's asset and wealth management industry promises to be very interesting to see unfold. Moving on, the FSA, Japan's financial regulator, has committed to the sound development of Japan's fund industry in its 2024-2025 Strategic Priorities document, with the goal of making the asset management sector the fourth pillar of the nation's financial industry, joining banking, insurance, and securities. The FSA outlined several initiatives in their Strategic Priorities document, the first pertaining to contributing to sustainable economic growth through financial mechanisms, which will focus on boosting fund management services, promoting sustainable finance, and enhancing digital capabilities. Other initiatives are to ensure the stability and reliability of the financial system and the provision of high-quality financial services, and to enhance the FSA's administrative capabilities. The first initiative will see an in-house department responsible for asset management established and industry associations consolidated, though no timeline was announced for these. The FSA has also requested that major financial institutions clarify their positioning of their fund management business in the wider strategy and how they intend to enhance operational capabilities. The incorporation of asset management into the FSA's strategic priorities follows Prime Minister Kishida's call for an overhaul of the sector in April 2023, and the Tokyo government launching several measures to develop the asset management services business. These were followed in September 2023 by PM Kishida's pledge to decisively carry out structural reforms in order to attract foreign fund managers to Japan. Following this, new retail products, changes to the pension funds, the announcement of special business zones, and other measures were announced and launched. The initiatives appear to have borne fruit, with new subscriptions into the NISA scheme reaching 10 trillion Japanese yen over the first half of 2024, putting it on track to reach its target of 56 trillion Japanese yen in mid-2025, 2 years ahead of schedule, and financial champions like Mitsubishi UFJ, Nomura, Mizuho, and Nikko Asset Management all committing to enhance their fund operations and intending to double their asset pools as early as 2030. Up next, the Korean Financial Investment Association, the self-regulatory organization of South Korea's financial investment industry, is pushing for revisions to regulations to allow tokenized securities and virtual asset ETFs, with the chairman noting that 2024 was one of the toughest years ever for South Korea's capital markets, with fund firms struggling amid the various forces buffeting the industry. These included a real estate project financing crisis, prolonged high interest rates, declining business following the US elections, and geopolitical uncertainty. Kofia also noted that investors had responded well to digital assets in other markets, and that allowing token securities and digital asset exchange traded funds would help strengthen the nation's capital markets. In contrast, the Financial Supervisory Service, South Korea's integrated financial regulator, is not so convinced on the benefits of digital assets, rejecting an application in November 2024 for an ETF which would have invested in virtual asset companies. The move stands in contrast to other regulators across the region who are much more crypto-friendly. Hong Kong and Australia have allowed virtual asset ETFs to launch in their jurisdictions, and Singapore recently saw several tokenized funds launched as well as examples. While the FSS has reportedly not officially banned the launch of such products, its rejection citing a 2017 measure pertaining to emergency measures on virtual currencies, the government directive prohibited financial companies from holding, purchasing, and investing in virtual assets via administrative guidance, though the digital asset landscape is vastly different from when the measure was enacted. Meanwhile, in Thailand, a proposed framework which would allow for the inclusion of digital assets in mutual funds has not met industry expectations, with fund managers citing areas like disclosures, advertising, holding periods, custody, suitability, and investable assets as areas where it is coming up short. A total of 23 financial service companies were surveyed by the Thailand SEC, including 6 fund management companies, 7 commercial banks, and 1 securities firm between October and November 2024. The framework would have allowed for public and private funds to invest in crypto assets and investment tokens, with retail ETFs and foreign collective investment schemes being limited to 5% of the fund's net asset value. Industry respondents stated during the consultation that disclosure aspects would impose a burden on the business operators, and the consultation process document did not address the concerns raised by the industry. Thailand first saw a Bitcoin ETF launched in June 2024, though it is limited to high net worth individual investors and institutional investors. Other markets, like Japan, are also seeing a groundswell of support for allowing digital assets in investment products, and those which take too long to accommodate this demand or adjust regulations may see themselves lose ground across an increasingly competitive region. So, that is this episode's section on APAC. Check out our profile for this episode's other sections, and let us know in the comments if there was an important development that you think we missed and should have been included. Many thanks for watching. Hope to see you next time.